Welcome to Counterpoint. I'm Tanya Granick Allen. Inflation, inflation, inflation. You cannot go 1 hour without the news cycle commenting on rising inflation, and rightly so. If you've gone to the grocery store lately, you'll notice that food prices have suddenly been going up. Fill up your gas tank lately? You're paying a lot more than you did 1 year ago. And with high inflation comes higher interest rates. Were you one of the Canadians who bought a home during COVID and selected a variable mortgage rate? Well, you might be struggling to make those mortgage payments now. Yes, everything costs a lot more these days. So what will the government do to curb inflation? Are we headed for a recession? And for how long would it last if we did? Well, joining me now to share her expertise is Saijal Patel, founder and CEO of Sage Wealth Consulting and host of Strictly Money here on the News Forum. Welcome, Saijal. I love interviewing fellow hosts on the network, and this is great to have you on today.
Well, thanks for having me, Tanya.
So a lot of our viewers have written in and have been asking me, can you do a show on inflation? And I've been wanting to because, while we're not a primarily money or investment focused show, many of our viewers do have investments, do have homes, buy groceries, fill up their tank. So could you please, for our viewers, explain what exactly is inflation?
Yeah, so inflation is the overall increase of prices for goods and services. So for our purpose or for our viewers' purpose, we look at consumer price index (CPI). So what they do is they take a basket of goods that the average person spends money on, and they track how much or how the prices change, either up or down. So they'll look at things like housing, for example, right? Rent, mortgage costs, maintenance. And so that makes up the biggest weighting of the basket. And then you have things like transportation, car costs, repairs, gasoline, which is the second biggest weighting in the basket, and then food and clothing and so on. The reason why we pay so much attention to inflation is because, and why it matters, Tanya, is because when prices go up, it erodes our purchasing power. So, for example, if what we could spend $100, what $100 would buy, say 2-3 years ago, it doesn't buy what it does today. And so that's the concern. And there's been actually a lot of debate on whether we actually need inflation. I get asked that question all the time, like, why do we have it? I think people would say that high inflation, like what we're seeing now, is a terrible thing. But pundits would say that you need some inflation, some moderate inflation, because it motivates people to spend today and not save for lower prices, which would actually be deflationary, and that would be a bad thing, right? So by people spending, obviously it keeps businesses profitable. But the key is it has to be moderate inflation. And that's why you'll hear central bankers talk about that 2% inflation rate.
As being a healthy rate, the 2%. So you mentioned, you touched upon deflation, and I'm glad you did. So if everybody just stopped spending all of a sudden, that would be deflation, that would be bad?
If prices had to come down. So if people stop spending and people have to cut, and businesses have to start cutting prices, then that's deflationary, right? And that means businesses start losing money. So you saw that for a long time in Japan, and they still are struggling to 15, 20 years later to get out of a deflationary environment.
Now, there have been many pundits speculate as to what caused this inflation, and there's some ideas. Obviously, with COVID, that kind of spawned this, tight supply chain management. We saw a lot of the government infusing cash, giving out stimulus spending, things like this. Could you explain how all of those factors will factor into what caused this inflation? We have about a minute before commercial.
Sure. So I would say the pandemic sort of created a perfect storm, if you will, right? You had lockdowns. So with the lockdowns, what you saw is the government and central bankers trying to assure people that everything was going to be okay, that they would be the backstop. So central bankers started, flooding the market with liquidity, even more liquidity than what was there even before that, right? You had interest rates cut. You had governments handing out CERB checks. So a lot of people were building up this cash and still spending. Like, don't forget that even though they maybe weren't eating out all the time, people were renovating their homes.
Yes.
They were eating out, right? So they were spending. And then when things started opening up, there's all this pent up demand, and people are spending even more.
Okay,
And
I'm
the
going to
issue
pause you
is that,
there. We're going to pause you there
yeah.
and we'll discuss that just in a few moments. Welcome back. We're covering inflation and deflation and interest rates here on today's show, Counterpoint. And joining me is Saijal Patel, founder and CEO of Sage Wealth Consulting, and of course, a fellow host here on the News Forum with her show, Strictly Money. Saijal, before we went to commercial break, we were discussing that perfect storm that COVID kind of created, where a lot of people were at home looking to spend, the government throwing a lot of money their way. And then what happened?
Yeah. So, as things were opening up, Tanya, people were, this pent up demand started going up and people wanted to spend. The problem was we also had to still deal with supply disruptions. Things had still shut down, right? We weren't getting the ships over from places like China, and we rely heavily on places like China for our exports. Workers weren't coming back to work. So you have a lot of demand chasing a lot of less supply. And so that's created an inflationary environment as well. And then let's not forget the wild card. All of a sudden, you have this conflict with Russia and the Ukraine. So oil prices go up, and that feeds into pretty much everything, right?
Yes.
Transport costs or gasoline. Yeah.
Transportation was a huge disruptor. You're right. When we saw those cargo ships sitting off the coast of California, the delays to unload from the point of manufacturing to unloading a ship was just doubled, which was unprecedented. Prices were going up. And then, of course, in Canada, we saw what a huge disruption we had when they brought in the vaccine mandate for transportation. That also caused more aggravation with shipping and trucking. There were a lot of factors that kind of, as you rightly said, created this perfect storm, if you will. So with Russia, and let's talk about the oil and gas for a moment, with Russia's invasion of Ukraine, how did that impact the oil and gas sector? How is that impacting us at the pumps?
Well, it obviously disrupts supply. So that's one of the biggest issues. Now we relied a little bit in Canada on Russian exports, so we can't really forget that. But there's a couple of things that factor into oil prices. One is the obvious, which is less supply, and just the geopolitical risk itself is
Hmm.
going to raise prices of oil. So those are some of the factors, and we produce oil and gas, but we also export, and we're reliant on exports for that too. So, unfortunately, that's keeps us vulnerable
Yeah,
in a
part
way.
of the
Mm.
perfect storm, I think, has been, as we've seen, there's been a lack of interest, if you will, or a lack of federal, maybe, can I say, cooperation in unlocking a lot of that energy wealth potential. And in Alberta, we see Alberta and the feds just going head to head many, many times between the carbon tax, et cetera. But let's talk about another time in history where we have seen these astronomical oil prices. And actually, we saw the last time we had high inflation. It was in the late 70s, early 80s. Inflation got to double digits. Now, we're not there yet. How did they solve it back then?
Well, let's not forget that it was Paul Volcker who was the Fed chair at that time, and yeah, he did tackle inflation, but it came at a great cost, Tanya. I mean, we went into recession, not just one, but two, back to back. The markets tanked and they stayed volatile and low for quite a long time. You saw stagnation, so not a lot of activity, and some would argue that we're still sort of paying the price for that, right? Public underinvestment. So I would say there's a couple of lessons that I think we can learn from that, hopefully, and that is as central banks are raising rates to trying to cool the economy. Hopefully, fingers crossed, we're not going to see a hard landing. So we'll see hopefully a soft inflation, because the thing that I can get concerned about as well is the impact that this is going to have, a, on bankruptcies, maybe not so much job loss because employment is pretty tight right now, the employment picture,
Hmm.
but also what it means for underinvestment, because that's not what we need right now, right? We need money to go into things like roads and schools and housing and hospitals for our healthcare, not just for our society now, but we also have a million immigrants. There's backlog, so that would be my concern. If I could just make this one point too, there's a lot of focus right now on monetary policy
Right.
and what the central bankers are doing, and I would probably be the first to criticize some of the things that they did. They left interest rates way too low for way too long, creating asset bubbles in housing and the stock market. They were late to the game when raising rates. But I don't think we should ever forget about the fiscal policy. It
Okay,
might
we
not be
have
as
to. I'm going to pause you
immediate.
there. We got to cut to commercial, but we're going to pick this up in just a moment. Welcome back. We're tackling high interest rates, high inflation, and joining me again is Saijal Patel, founder and CEO of Sage Wealth, and obviously fellow co-host here on the News Forum, where she hosts Strictly Money. Saijal, we know that interest rates are rising, but they were critically low for a long period of time. You were saying that you were sounding the alarm as to why that was a dangerous, perhaps, situation. Could you please expand on that?
Sure. Yeah. Interest rates have been low for a very long time, Tanya. I mean, I would say, since the great financial crisis. And I was arguing at the time that there was no reason for interest rates to be that low when the economy was humming along, right? Everything was going very fine. And what it had done, the unintended or intended consequences, if you will, is that we had housing bubbles and we had a stock market bubbles. So if you look at valuations, they shot up and they didn't make sense. When interest rates were that low, people got addicted to debt and
Yes.
indebted, and on every level, Tanya, it's households, corporations, government, and at some point, that we end up paying the price for it, because people have to cut back, and so you're seeing that consequence, the consequences of that. But on top of that, you're seeing the consequences of high inflation, which has
Right.
really eroded people's cash flow.
So you brought up a great point. So you're right. Money was cheap. You could borrow very cheaply, and
Yeah.
many persons, especially in the time of the very beginning of the first lockdown with COVID, they realized, wow, to have a home office, my space is a little small. Money's cheap. I'm going to upsize my home. I'm going to get into a variable mortgage. I mean, how high could it really go? And they bought, maybe further out of the city, bigger, more of a palatial residence. And now we're seeing interest rates rising, and all of a sudden, maybe their mortgages are going up by 50% a month. Their mortgage payments. It
Yeah.
created, like you said, this perfect storm. So with these mortgages with variable rates, I mean, what does this mean for Canadians who might be stuck in that situation? Will people start losing their homes?
I don't think so. I'm not really that concerned, at least not yet. I'm not seeing the signs. I think we have to remember and just sort of look, step back and take some perspective on this. Now, 40 to 50% of homes, Tanya, are mortgage free.
Oh
Yeah,
wow.
which is a good thing. Yeah. I would say it's something like 25 to 30% are in variable rates. So no doubt that they're taking a hit right now. For others who are in fixed mortgages, if it happens to come due next year, they're obviously going to see a sticker shock as well. So but overall, because housing prices are so much higher, obviously their mortgages are probably a lot higher too. And then on top of that, you have inflation that's cutting into a household's cash flow. I'm more worried about the psychology of people in homes right now, because there's just a lot of media and fear being played out there, like, oh, the value of your home has gone down. Well, that's going to happen when interest rates go up, and I want to remind viewers that that is wealth being eroded on paper.
Hmm.
Right. You're not locking in losses or lower prices until you sell your home. So I wouldn't worry so much about that. The people that I sometimes do worry about are those who are using their home somewhat as an ATM. right?
Right.
They're pulling money out using HELOCs, home equity line of credits, which are going to be attached to variable rates. So there was some concern there. I don't think houses prices are going to drop that much, or we're not seeing it yet. Partly because I think the employment picture is strong. If people started losing their jobs, then that would be a different situation. And I guess time will tell, but I don't see the alarm bells yet.
Right. And we see that it's I guess you could say, a buyer's market in terms of employees looking to find a job. There's a lot of demand for workers. Um, let's talk about business. You mentioned about how interest rates can impact business. Many still haven't recovered from the pandemic after shutting down. How are businesses coping with the rise in inflation and the rising in interest rates? We only have about 40 seconds before commercial.
Sure. Well, they're not doing too well. I actually had Equifax Canada, they put out a report on how small businesses are doing, and they're really struggling with cash flow. Many of the businesses have said that they're being forced to raise prices when they don't want to because supply. They're forced to raise wages, and this just eats up into their cash flow. Debt has gone up something like 15% for the average business. I think the average outstanding amount is about $37,000. So if they are tied to sort of variable rates, then obviously they're going to be impacted as well.
Okay, we're going to pick this up in just a few moments. Welcome back. We're wrapping up our discussion on inflation and what you, perhaps as a Canadian household, can do and how long we think it might last if this, in fact, turns into a recession. And joining me is Saijal Patel, founder and CEO of Sage Wealth Consulting and host of Strictly Money here on the News Forum. Saijal, Canadians are sort of caught off guard. We haven't seen this in a few decades. What should Canadians be doing to better prepare for what seems to be like the continued rise of inflation?
Yeah, it's tough for so many people, and I really do feel for them. And I would say, have a budget. Number one, and I know it sounds kind of trivial, and a lot of people don't like doing budgets, but in my experience, Tanya, and I work with hundreds and hundreds of clients with my financial education business, right? We are subconscious spenders most of the time. We're emotional spenders, just as human beings, and sometimes we are not aware of what we spend. And so when we create a budget and we compare where we wanted our money to go to where it went, you would be surprised at how many things are, how eye-opening it is. People don't realize that, oh, I spent so much on this when maybe I shouldn't have. So that's a start. Just practical tips. I think even with groceries, right? Buy some of your staples at more of the discount stores. The suppliers are the same. So, take advantage of that, take advantage of sales. Think about how you store your food, because we waste a lot of food just because it goes bad or we throw it out. So sometimes meal planning and proper storage helps. Utilities, shut off your lights. Don't have all the lights on in your home all the time. Think about doing laundry on the weekend when energy prices are usually lower. Think about filling up your gas in the evening when gas prices come down. So those are some of the practical things. And if you're concerned about recession, and you feel like your job is vulnerable, then build up that emergency fund. Right. You should
Right.
have about 3 to 6 months of emergency savings, 3 to 6 months of your household income as emergency savings, because you just don't know what comes up. And emergencies always come up, Tadia.
Yes.
Your fridge breaks down, car repairs, all sorts of things. And what I find is when people don't have that, they start relying on expensive credit card debt.
Yes, and that is definitely even more expensive than a HELOC, so with a variable
Yeah.
rate, so definitely.
Yeah.
So
If I could, sorry, if I
no, go
can
ahead.
make one point too, investing. So I'm seeing a lot of people panic right now because markets are down and they're wanting to sell. And I would say that would be a huge mistake. Again, another lesson that we can learn
Right?
from the 70s and 80s when people panicked and sold. Because you have to remember that investing is a longer term game.
Correct.
If you need that money in a year or two, year and a half, it should have been in liquid, safe assets anyway.
Right.
You need a 3 to 5 year time horizon for stocks to recover. And we see corrections, but we also see markets recover. We just don't know how long it's going to take.
Right, right. And so, speaking of how long it's going to take, if you had a crystal ball, Sajal, how long would you predict this rise of inflation will continue?
Yeah. Boy, it is a wild card. We saw inflation tick down just slightly, to 6.9% recently, but that had mostly to do with lower oil prices. And now we're starting to see oil prices creep up. So my concern is they don't quite have a grasp on inflation. Supply disruptions are slowly working its way through. We're definitely seeing evidence of that. But having a tight employment picture is also a bit of concern. I think we have to remember that here, a lot of people retired. You have the government hiring lots and lots of people. So a lot of jobs are moving from the private sector to the public sector.
Hmm.
So the average economy has to deal with that. So these are issues that I can't see inflation being tamed down for at least 6 to 8 months. The central bankers have said they're going to continue to raise rates until it does come down.
You have 15 seconds left. What signs should we look out for when we know we're near the end?
I think those signs, like we really do need inflation to come down at least to 4 or 5%. Markets also don't like uncertainty, so you need some of those factors, some certainty to come back. We got midterm elections, the Ukraine Russia deal, uh, conflict. So some of that stuff has to work out before we start seeing a bit of a recovery.
Okay, Sajal, thank you so much. Really appreciate you having you on today.
Thanks for having me.
So it looks like we're going to be in for a bumpy fall, perhaps even into the winter and spring, but I'm optimistic. I think we will get through this and we will look for those signs. For Counterpoint, I'm Tanya Granick Allen.